Great job. Thank you very much. That was great information. Beth, you'll come up. Beth Kormanik, she is the editor of Hotel Interactive. She's going to moderate the panel. Scott Corrigan from Hospitality Finance Solutions, please come up. Teague Hunter, president of Hunter Realty Associates. Preston, senior vice president, Fidelity Bank, one of the sponsor, one of the largest sponsors for us. Thank you. And Jatin Desai, director of investments, Peachtree Hotel Group. This is going to be a great panel discussion. Please take notes in your book. Any questions you have, we really want to get them answered. We're running a little behind, but that's a good problem, really. I mean, so because I want to make sure everyone gets the information. We'll keep things paced well. But any questions you have, I'd love to have them answered.
Russ, we have a question here.
Okay, go
Are we
ahead.
going to get copies of all the slides that have been shown?
As long as the people who have presented here don't have a problem, Debbie says that's fine. Tim? Good, and mine as well, and Mike, sure, absolutely.
We'll be on the website by next week.
Yeah, on the website. Look at our website. There, it's in the booklet, ushotelapraisalscom. We'll have everything, including probably some video. Okay, thank you very much, Beth.
We have a great panel here. As you've heard, these are people who are going to talk about some hot button issues that I know you're interested in, and we will have time for questions. So be thinking of that, and should something come up in the middle of the discussion, just let me know. I know there are microphones throughout the room. So we are talking about hotel financing in today's environment, and let's just start with what borrowers need to be concerned about. They have to look at their entire portfolio as well as the subject property, because lenders are going to want to see their global position. So I'm hoping we'll just start out by talking about proper loan positioning, where you need to be. Who wants to start with that one? Scott?
I think that's one of the biggest things that we see today is individuals come to us and, they still are, a lot of people still think that financing is going to be like it was in the 2005, 2006, 2008 years. And unfortunately, that's not the case. No longer are lenders looking at just the subject property, but they're looking at the subject property and every other property you have. Any other asset, usually over 20%, that you are a partner or investor in, they're going to look at that. So, you need to be concerned about your global cash flow. Lenders are going to look at that your global positioning, and make sure that there's no assets within your portfolio that are being a drain on everything else. Even though they are looking to make a loan on just that subject property, they're still going to take into account everything else that you own and you're involved with. And so that's something that I think is very, very important. And then the other thing that I tell a lot of borrowers is, especially in hospitality, timing is very important. If you think that you might have an upcoming loan maturity, try to be proactive as you can with it, and try to go to the bank and see if they might look to renew it. But as we know, a lot of banks in this environment are not looking to renew their loans. So with the hotel, now is about the best time to look to refinance your hotel. We've just gone through busy season, busy summer, probably with the exception of Florida. The summer is the strongest time for most hoteliers. So now is a great time if you're looking to refinance to try to move something forward, as opposed to waiting until the end of the year. Then if you're getting into the first quarter, they look at, most lenders are going to look at 30, 60 days in financial statements. And usually in the first quarter, most hotels outside of Florida, that's usually when your demand and rent is lowest.
So we'll talk about timing a little bit later as well. Danny, is there anything that you wanted to add about that, about your loan positioning?
Yeah, it's been a kind of a mixed blessing. We're obviously seeing a lot more sophisticated borrowers, which means, they own many hotels. So, the underwriting of that can get difficult. You got to bring in the global piece of it. So you get stronger management, but it's also, you got to look at every property to make sure things it's kind of a mixed blessing.
Jatin, I wanted to bring you into this. Not that this applies to any hotel that you've ever been involved with, but how does one refinance an over-leveraged hotel?
There's different ways to do it. I mean, obviously, you can bring in different equity partners to add in equity, and you sell position, part of your equity to them, and they become your partner. We've seen that happen in some situations. There's expensive mezz debt out there that most of us probably don't want to add, and our first mortgage lenders usually don't, look too favorably to that. But typically, what we've seen is that if you work with your current lender, you figure out what the value of your asset is, and if you can find another lender that is reasonably priced, and if you can afford them, then typically that's how we've seen it happen in the past. But the SBA is one way to do it, kind of what Tim was saying, that you can figure out what your asset's worth and bring in the SBA. That's one way we've seen. But primarily it's really bringing either high yield debt or kind of mezzanine.
Mm-hmm. Again, are you seeing over-leveraged hotels that are coming to you for solutions?
Yeah, and it's either the bank taking a discount. I think Tim alluded to that as well. There are several bigger banks that are willing to take a discount to get it off their portfolio, or equity coming in.
Mm-hmm. Mm-hmm. And Teague, did you want to add anything to that?
Yeah, Dave, will you guys take discounts?
Way to put them on the spot. But I think one of the messages is to be proactive. And, if you have a pending loan maturity, you can't just assume that the lender's going to come to you. You have to, be willing to go to the lender. So who wants to expand on that? Yeah.
I'll say this is that our company has kind of shifted from becoming a traditional real estate shop to more of a lending institution, to where we are buying notes from larger banks. And a lot of the notes that we've seen is that the borrower just didn't, there's a maturity coming up in 6 months, never really went to the bank to figure out what was going to happen, and just assumed that they were going to get a renewal just because they've gotten one in the past. But kind of have to think of how the bank's looking at it, and the bank might be pooling you with an asset, a number of other assets that you might be making your payments, doing just fine. All you have is a maturity default. There's no other real default that you have on your asset, but the bank's reserving against you and kind of putting you in that class where they will sell your note, and the new buyer that comes in at your note will probably work with you, or they might come after your real estate, or whatever the case might be. But just be very conscious if you've got a maturity coming up, or if you're in a technical default, communicate with your lender, because that's really the best thing you can do for yourself.
Scott, are people coming to you, or are they kind of waiting, covering their heads, hoping that things are going to get better?
I mean, we've been staying pretty active. I think right now we're working on about 40, 45 finances right now. And that's a combination of refinance, acquisition. I think we've probably closed on 5 or 6 rounds of construction deals. But I do always tell the borrowers to definitely be proactive. Go try to sit down with your bank. Now, whether they tell you or they don't tell you what their real interest is when that loan matures. But I still think it's just a great time now to try to be active and try to see what other things might be out there. A lot of times I'll say, just send me your information. Let me analyze it. Let me see if we've got to mitigate cash flow or trends, or if we've got to mitigate loan value. And those are typically the big things. Most lenders right now, they want to see, they look at those 3 things primarily. They're looking at the trends, see how you did kind of 2008, 2009, 10, how you're doing this year relative to last year. Then they really start to look at, of course, loan value. That's a big thing to see. And because I think once you know that, you can start backing into structures for them that might work well for their situation. Obviously, if we're doing pretty well, but their monthly payment with their current lender is just too tight, they're on a 15-year AM, you can maybe look to do SBA 7. Stretch that AM out to 25 years would help quite a bit. Or, once again, like Tim alluded to, I've worked with a lot of Tim in the past for many years. If you've got a leverage situation, the ability right now to get to 90% is crucial in a lot of hotel situations. A lot of hotels that have just lost a fair amount of value in the last couple of years. So, but you definitely got to be proactive with your bank and don't wait, because
as we heard earlier, there's a lot of uncertainty about 2012, and I'm wondering how that affects things. When you can look at the past performance, but nobody's really clear about where things are going.
Yeah, and I think from what we've seen is as long as a property can start to show at least stability, that there are no, that, I mean, if they had declining trends from '08 to '09 and 2009 to 2002, but that percentage decrease was not as bad, but at least if we can show that, okay, you've kind of turned the corner, 2011 is pretty much flat, maybe you're up at RevPAR 1%. Usually they going into 2012, most people make the assumption that if your property's in a good area, you have a good brand, you've got through the last couple of years, that things are going to get better. But they definitely look at those trends quite a bit right now.
Let's talk a little bit more about brand, and Teague, I'm hoping that you can talk to us about this, but brand, location, the age of the asset, all of this comes into play. What are some of the most important factors that you're seeing right now, and how about these owners? Are they more willing to switch up the brands these days to get things going?
Yeah, I think I gotta look around the room and see who I'm about to offend. Fortunately, I think it's just us, so we can talk. I think everybody knows it's not rocket science. The brands that majority of the people want, at least the real money wants today, are Hilton and Marriott product. And they want major MSAs. That's where your values are. Now, if you don't have that, or if you can't get to that, and if you said another way, if you want that, be ready to pay for it. If you don't have that, then what? I mean, there are ways to make money, good money, without having those brands. Some of the other brands, you got to figure out who they are and what they are. Choice, Carlson, those are Wyndham, those are decent brands that aren't asking you to spend so much money on renovating the assets. Now, the biggest factor, I'm off tangent, you got to keep it back. PIPs are a big issue these days, so I'll get to that later. But stay with your brands, make sure, and today, the best thing I think you guys can do with regards to brands, there's a lot of ways to make money by using sort of that sweat equity. Finding the assets that are struggling, that do need issues, that do need a brand. Find it, add the right brand, up-brand it, side-brand it, get in there, change the brand, and add value. There's a lot of distress out there, there's a lot of opportunity.
Is it even possible to finance independence? Do you have to have a brand?
We think you have to have a brand. Yeah.
It's not impossible, but it's very difficult.
I'm seeing lots of nodding heads, yes. Okay. How about new brands? In my job, I hear a lot of people, here we're working on this new brand, or we're now saying we're starting a new brand. And they have big ideas, and I'm sure they're talking to all of you as well. How are those faring? What do you think about that?
Yeah, we have a very defined box on what we'll do, so it's not something we will look at, so it makes it tough.
I'm going to put words in Danny's mouth, but there's a lot more lenders out there today than there ever have been. That's the good news. And the good news is if you can get a loan, you can get it at pretty good rates. The bad news is that it's a very tight box, and it's all asset-driven and sponsor-driven. And you better have shown that you've done it a lot. You better have shown it's better be a cash-flowing asset. You better put a large equity injection into it. Danny, am I wrong?
You're right.
I think it's everything everybody knows. So the ways we're getting deals done today, they're all cash. Whether it's $1 million or $2 million, small, people can write checks. The higher end, it's all REITs, candidly writing checks, or SBA.
Chief, what are you seeing with the REITs? I was just reading something that we're going to see a lot of slowdown with that. Do you expect that in the next year?
Yeah, the REITs are kind of on the shelf for the remainder of the year. I think fourth quarter, all their stock prices down 25%. So they can't really buy anything at the moment. So they're self-admittedly on the shelf for the rest of the year. We'll see what happens with their stock prices and where they are come January.
So new construction, we heard earlier from Mike that one of the things that existing hotels are going to benefit from is the low supply. So what are your thoughts on financing new construction? When's that going to happen? And what's been your experience seeking it?
Like I said, I mean, we've closed about 4 or 5, and I think we're on our 6th round of construction deal right now, and all of them have been pretty prominent brands. We've done 2 or 3 Hampton Inns, we've done a couple Candlewood Suites. I think we've done the Holiday Inn Express. But probably the biggest thing that those lenders are looking at are, obviously location, brand, looking at the group, and of course, they're still going to get into the whole local cash flow. But then the one thing that they really want to see, and that we have found that's gotten us over the hump on a lot of the deals that we've gotten closed are, even on an SBA deal, if you've got 20% equity injection, or 25%, or if we're trying to get it done conventionally at a 30% equity injection, those lenders want to also see that after you've put in that 20 to 30% equity injection, you still have substantial liquidity. That's the other thing. If you could put that injection in, you've still got enough liquidity to kind of manage your existing portfolio. And then if there's any issues with cost overruns, things that are of that nature, we can get them done. But most of the banks we're working with are banks that are going to have multiple relationships with that individual. They might have deposit or many deposits. They might have lines of credit. They're going to try to capture the entire banking relationship. There's not a lot of national lenders out there that were in 2007 that are going to look at deals all over the country. So I think that's the bigger thing. We're working with a lot of community and regional banks to get these done, and just because this particular asset will fall in their lending footprint. So,
I think we have one development deal that we're working on now, and it's right beside the hotel that we just opened in April this year. Opened up very strongly. Still has been a challenge to get financed, but the way we're getting around that is just subsidies. So we created a TIF district, new market tax credits. So really using these programs that are out there to subsidize the development to make it make sense again. Because it's difficult for a bank or even as developers or owners that if you can go out and buy an asset for 50 to 70 keys, you can go build one for 80 to 120 keys. So it has to make sense. And the reason to make that happen is federal subsidies or local subsidies or whatever you can get out of your, wherever your property is located, whether it's a distressed district or whatever it qualifies for really.
What did that add to the timetable?
It definitely added about 8 months to the timetable, but we were able to get pretty significant subsidies to make the project make sense.
Yeah, I want to add to Jatin, he's right. If you can use those subsidies out there, they're huge right now. And it kind of depends on where you are. We just had a client do some stuff in New Orleans. And you can think of all the Hurricane Katrina, all that kind of stuff, the GO zones, everything. They added it up. They had new market tax credits. They had Katrina tax credits. They had all kinds of stuff. And Jatin's right, it takes a lot longer. You got to be willing to go through the headache and the brain damage. But I think that's the kind of world that we're in today. Nothing's easy anymore. So you got to be willing to roll up the sleeves. And the guys that can roll up the sleeves and stick with it and get it done are going to be the ones that are farther out ahead in the future. But these guys got a deal done in New Orleans for very little real equity out of pocket on a very sizable transaction.
Another thing to look at would be these green incentives. I'm wondering if anybody has had experience with incorporating, whether it's LEED or any other type of green, whether it's a water conservation or solar panels, these kind of things that get incentives and credits. Has anyone had experience with that? Those type of projects?
One thing that we've done is with the SBA Green Program is you don't necessarily have to put solar panels up or anything too crazy. It's more use a certain type of electrical outlet versus another, and you have to have a consultant come out and look at your original drawings and then your modified drawings to really quantify what you saved. And there's a threshold, I think, within the SBA. I'm not sure what that is, but it's a certain percentage that you have to demonstrate that you saved versus your original plans. And as long as you can do that, then you qualify under the green program.
Yeah, does that make any difference to you when you're considering a package, or is that just irrelevant?
Yeah, well, these size standards now are below now. That will make a big difference. 2010, I think it was, we did a couple projects that we used to green. And it did help then, but now a lot of other things matters. Did that?
It just helps that you don't.
If you got multiple
You need the eligibility.
Yeah.
So what are some of the questions that you are hearing most from people who want to get projects done? Is it when are the purse strings gonna loosen up? When is it gonna be easier again? What are the questions that are top of mind that you're hearing from owners, whether it's for new construction or refinance?
I think one of the things that we try to do with most of our clients is we try to, at least on the front end, discuss with them, that, okay, if this is a project that works, and we've gone through it, we've mitigated the risk for whatever bank we're going to deal with on this project. I think if it's one of those situations where you can, clearly demonstrate to the lender that it is a good project, it makes sense, and you can mitigate a lot of risk, and we've had success. But we always also try to educate the borrower on where we are today in today's cycle. You're probably not going to get the lending and the types of structures and deals that you've got in 2007. You need to be aware of that. Obviously rates are at all-time lows, but that doesn't always mean that you're getting that rate. All that means is you're going to get a higher spread. So spreads were so compressed in 2006, 2008. And now what the banks are doing is they're basically, even though the rates are low, they still might give you a pretty good spread on a variable rate. They're going to have a floor. Most banks that we deal with around the country, probably 90%, even if they offer you a low variable rate, they're still going to have a floor. So.
Jen, how do you handle the process when a non-traditional lender has purchased your loan? What happens then?
I think that we're kind of the example of the non-traditional lender that's out there purchasing loans right now. I guess it all depends on how the borrower looks at it. You can look at it as kind of an opportunity because the non-traditional lender is not regulated, so they don't have to qualify and reserve for certain things that traditional banks have to. So you're able to kind of be a little more creative. Usually if they bought your loan, it was bought at some level of discount. Now, the days, 2009 when notes were being bought at 20, 40, 60 cents, that's no longer happening. It's closer to par. It's some slight discount to par, and typically it's a person can non-traditional lender can be buying it just as a yield play. So they're typically going to want to work with you because that's usually their highest investor coverage to work with you. You have you pay it off, and that's kind of what their goal could be. But they understand the business, and if it's a situation where they have to take it back, I'm sure they've taken that into account too. But I think that if someone buys your note, I think the best thing you can do is really just communicate what your goal is, and just tell them really the story that you're in. If you're struggling and you need to figure out how to make your payments, then talk to them about it. But it's really just being completely open and honest with them to make sure that they understand where you're at, you understand what their goals are, and kind of make it a win-win for both of you.
Hey, Beth, excuse me. Can we open up to Q&A for time's sake? If there are some questions, if not, we can go about 10 more minutes.
Great. Okay. Does anyone have any questions so far? Great panel up here. Lots of knowledge. No? Okay. Well, we will. If you have any questions, just raise your hand. I want to talk about PIPs for a second. Teague, I know you brought that up, and I'm wondering, are you finding that they're getting done before transactions happen, so that the properties are more, a better package before they go for sale, or are people trying to sell properties that have PIPs and waiting?
God, it'd be nice if they were done. Fully built, beautiful hotel. No, nobody has any money, so obviously the properties are in need of some capital improvement. And that's the biggest thing. I think franchise companies were understood, we're letting everybody go, and we're not being so tough on brand standards, but times have changed. Franchise companies see that the world's coming back, and they're going to start demanding. Even if you own the asset and aren't selling, they're going to demand that you start to sell. And candidly, that's driving a lot of assets to market. Guys that don't have the money or have it but don't want to spend it come to us and say, all right, we want to sell. The reality is that's probably our biggest bid-ask spread issue today are the PIPs. Whatever the asset is, it's a pretty big number because they want to get their assets brought back. And I don't know if anybody saw the news just this week. Hilton Gardens got a new lobby. Good Lord. Thought they were the youngest brand on the market and had a new fancy lobby, but apparently it's not new enough or fancy enough.
Lobbies are big. Lobbies are big these days, and we're seeing new prototypes of guest rooms. I mean, this is an industry that's constantly reinventing itself. The issue is you have to pay for that. Jatin, from your perspective, how are you approaching PIPs? Are you finding that brands are being more strict about these things these days?
I think that depending on the brand you're dealing with, I mean, they might give you more time, but you're gonna have to do it ultimately. So you might have, a PIP that has to do the guest rooms and the lobby, well, they might let you stage in the guest rooms after you do the lobby, or vice versa, but ultimately you're gonna have to do it. And when we're acquiring assets, the negotiation regarding the PIP, it's usually, like, for example, when you buy a certain brand that's having a new prototype coming out, they're kind of in the middle of it, you have to kind of adopt some of the new elements and kind of blend it in with the previous prototype, and it becomes challenging, it takes a lot longer than you expect, only because the brand will hold you up. So just be careful what you negotiate in PIP, because we've all been victims of kind of varying items that you have to do and what not to do.
Danny, Scott, I'm hoping we can talk just a little bit about distressed property auction short sale scenarios. What's the trend in that area? Are you seeing more or less, and how are those typically going?
We're actually working on quite a few DPOs right now. Usually the thing that I tell most borrowers that if you are having negotiations with your current lender on possibly getting a discount, I mean, if they're kind of coming to you and saying, hey, we're not going to redo it, but we know your leverage is high, but we're willing to give you, or work on some sort of discount. The main thing we tell borrowers is to continue to make your monthly payment, because at that point in time, when you stop making your monthly payment, then that starts to make you ineligible for a lot of these SBA programs. And these are the ones that we need, especially if we have a high leverage position. So, we are, I always tell that to borrowers, make sure you keep making those payments. Make sure you keep submitting that payment, even as you're working through and trying to negotiate that discount to pay off the loan. Something that's very important to know.
And that's been our biggest issue, of the ones that we've seen, they've stopped making the payment.
Yeah.
Makes it ineligible. So this is a big challenge there.
It's just a matter of educating them, or they have no choice at that point?
Well, a lot of them, I think if they stop making payments, they can force the lender into taking a discount, so I think they shouldn't.
It's a bad idea. It's a bad idea.
If you want SBA financing, you may get it.
Well, but even if you don't want SBA financing and you're getting some sort of discount, you're probably at a leverage point that you can't get a conventional loan. You're probably not going to be at 65, 60%. And that's kind of the conventional lenders that we work with. They're anywhere from 60 to 70% leverage. They're not going to go above that. Usually 70% is very built to start with some along those lines. So.
Question.
Just a quick question. What kind of as a borrower, what kind of discounts can they expect with the current lender that they're trying to finance?
Usually depends on the lender and the situation that lender is currently in. I mean, if that lender is having issues, their own internal issues with the FDIC and the regulators, then you might be able to expect a larger discount or discounted payoff. The other thing that a lot of the banks will do, though, is they might not give you, they will verbally tell you, this is what we're thinking. And we've run into this situation 5 or 6 times already, where they won't put anything on paper because they don't want every borrower coming in and trying to get a discount from them. So they will kind of verbally tell us that, okay, we can discount your note to this. We go out and get the financing set up and get commitment letters, then the bank comes back and say, well, now can we split this difference? Can you even though we gave you $1.6 million discount, can we take $600 and put it on a private note, don't take a lien on the property? Well, then we take that back to the lender, our lender says, well, that's actually changed. Because even that $600,000 unsecured note, which you're going to guarantee personally, that still goes against your personal needs. So sometimes it can be kind of a vicious circle in dealing with these DPOs and trying, because the process can go on for quite a while.
Another question.
Question for Danny, real quick. Have you heard anything on movement in the 504 first secondary market, kind of resale of being able to get rid of your first?
Yeah, we're actually.
And the reason I asked, I got a worksheet this week from one of the guys who emails regularly every week, and he had a list of all the states that they will and won't do. I don't know if you saw that, but on Georgia, it basically said no special purpose, and I forget what the other thing was. But Georgia, they were basically locked out, and I just didn't know.
Yeah, I don't think the program has taken off like SBA had expected. We are actually a pooler. We've sold 3 loans into the secondary market, but it's been our loans that we originated and pooled together. We haven't been going out and buying loans from other banks at this point. So, I mean, hopefully there'll be a big push towards 2011 to extend the program, and people can start making their smart business decisions on whether to really, go forward on it. So, a lot of them hadn't been done yet. So, unless Zions is going to buy it, I don't think much stuff's going to get done.
That's it, the whole state of Georgia is locked out.
Yeah.
Any other questions? Well, thanks so much. Give the panel a round of applause, please.